Good morning, everyone. I'd like to call the meeting to order and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Ojibwe, Inuit, Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 41st Nation in Treaty 3 territory. Our panel today is to my right, Linda McFadgen, and to her right is Gail Anderson. My name is Brent McIntyre, and I'll be chairing the meeting today. Our assessor for today's hearing is Matthew Barakas, and our administrative personnel is Jaswinder Kumar. To the Zoom participants of the hearing, please note you're placed in the waiting room until your property is called upon. When it is your turn, you will be admitted into the meeting. Kindly follow along on the City of Winnipeg's Board Revision YouTube channel for the hearing process. Once the host admits you into the hearing, please close or mute your YouTube player. You will then be permitted to speak with respect to your property. Once your hearing has concluded, you can leave the meeting. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. Statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by Council and it's independent of it and the City Administration. It makes its decisions based on the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the Board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of Queen's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the Board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed, each applicant following the swearing in. We will then have the assessor's testimony followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the Board will deliberate in private and make its decisions. You will receive the Board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We will be hearing items 1, 2, 3, 4, and 5 on our docket today. Mr. Kumar, please affirm the assessors and the applicant's testimony. Thank you.
Mr. Assessor, please state your full name.
Matthew Stephen Barakas.
Thank you. Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Thank you. Mr. Applicant, please stand up.
See, again, you always ask to stand up. You have to ask him to stand up.
Because he's not
not
a person.
Are you standing?
It's only for the in-person applicant, sorry. State your full name.
Rocky Newfell.
Thank you. Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Thank you very much. First item on the docket today is pardon me? The first item on the docket today is 230 Princess Street. And I'll ask both parties, are there any preliminary issues?
I'd like to forward some rebuttal information. I know the assessor got it. Yesterday, I don't know if the board got it.
We don't have it
Not yet. Yeah.
but we can deal with it during rebuttal.
Yeah, or I may just refer to it in questioning just to speed things up.
Check that's okay. Okay, Matthew, you can start your presentation.
Okay, thank you. File number 22-2012, roll number 13096146100, 230 Princess Street, roll year 2023. We've got two income streams on this because it's a resident multi-use apartment. Combined assessed value $6,092,000. Actual year built 1907, effective year built 1990. Number of suites 49, 33 outdoor parking spots. It's in the Exchange District, Princess and Pacific. Page 2, request for income information. They've been compliant with their income information requests. Page 3 shows our model income value summary. Pardon me. 9 bachelor, 31 bedroom, 10 2-bedroom. Their average monthly rent of $1,014.19 on the apartment side of the coin. You see our 2 income streams here, model generated income and expenses, expense ratio, and capitalization rate. Generates our model combined assessment of $6,092,000. Pardon me, page 4 shows what the model is assigned, not only the multifamily average rent per suite to be, but also what the retail rent is in our model as well, net rent, $8.46 for a potential annual rent of $62,858. Page 5 is our rent comparables. I tried to find some places in the Exchange District that were in regards to number of suites and falling roughly as close as I could into an effective year built bucket. You can see that they all contain 1 and 2 bedroom units. Our subject does have bachelor units, which typically go for lower than the 1 and 2 bedrooms comparatively. The only one that has a bachelor unit listed in my direct comparison here is comparable number 3, 316 Ross. You can see that the subject property falls at the bottom of the range of comparables. Page 6 is our list of comparable leases in the rough area of the property. So you can see that they're all higher than what we have the subject property listed at for comparable leases. Page 7. This is a chart. I know it's been in other presentations so far this season. What it is it's an example of some actual sales that took place in the market. I looked at the multi-year stabilized income on these properties myself, and I was able to stabilize multiple years and come up with capitalization rates. So you can see that there's a range ranging from 3.6 to 5.74. So with our cap rate here, this is only in regards to the multifamily aspect, keep in mind. These don't encompass any commercial. So at 5.3, our multifamily cap rate does fall within the range of some citywide examples. Again, these aren't meant to be comparable specific to the property. This is just a bolt-on that I've added that you'll see in all the briefs today to reference the multifamily cap rates generated by the model. Page 8, that is our capitalization rate chart that you see every year. So we've got our office, industrial, retail, multifamily, and hotel. Capitalization rates derived from model-generated estimates of net operating income and sale prices that were time adjusted to April 1st, 2021. Page 9 is our municipal excerpts that we've seen before, time and time again. Page 10. So I did take a look at the the actual 2020 income and expense statement submitted by the owner What I noticed was that there are a couple things that really stood out to me in regards to coming in out of spec. Management was a lot higher than the 5% that we stabilize at industry-wide. So I restabilized the management of 5% of effective gross income. And I noticed the repair and maintenance was really high as well at $2,725.94 per unit. Typically, when we get into this range, we see capital repairs being included in the total figure. Now, unfortunately, there wasn't a breakdown available on the mailer, and it wasn't clarified. So stabilizing at a more normal to high range of 1,500 a unit. The repair maintenance went from 133,571 to 73,500. Change those figures, recalculated the expenses, and then when you compare the restabilized NOI to our combined model NOI, the difference is only $963. Now, I did this because the expenses weren't broken apart by residential or commercial. I took the stabilized NOI as a reflection of both the commercial and residential net operating income. That's why I combined the model NOI to see if we were off, and it looks like we're within $1,000, so that's good. Then the rest of my brief, page 11, you can just see the mailer that was sent in. And then if you go down to page 15, you'll see pictures from the building, outside of the building, and then the last picture you see here is page 17. The property also encapsulates, there's a vacant parking lot. Well, it's not vacant, it's a parking lot under the same pit. So you can see it highlighted in the thicker purple line. That's all part of this pit as well. That's where the parking income comes from. People park across the street. So that's my evidence. Thank you.
Thank you. Rocky, any questions?
Yes. You just mentioned about the parking, but and that the lot is included in the roll, but you didn't have a revenue stream for that?
Revenue, I believe they counted parking in their mailer on page 11.
Yeah, no, I know what they're doing, but I'm just asking if you generally have multiple revenue streams for something like that, don't you?
Well, they're not renting it out. To our knowledge, they're not renting it out to the general public. That's for the tenants. So they don't get a separate revenue stream. That's income that's included in the analysis.
You're asking questions on the owner's behalf. I'm asking questions about the model. Wouldn't the model have said, give us a revenue for parking separately?
No, because it's not rented out to the public.
Okay. Now, have you been in this building? Any inspection?
My friend years ago, but I haven't inspected it as a worker. No.
No. Okay. And what floor was that on?
It's been a while. It wasn't the first floor, but that's all I can tell you.
Well, was it one of the shotgun suites or was it one of the top floor suites?
It was a bachelor suite.
Okay. And on this basis, was this the basis that made you assume that repairs were capital in nature, or do you have anything to go on for that?
No. Like I didn't really take that one time I was in there to heart. It looked like it had been redone. It just, in terms of the repairs, I just simply looked at it on a RM per unit perspective. Saw that it was out of spec and than we typically see. So I restabilized it to 1,500 a unit.
Okay, so, I don't want to put words in your mouth, but do you have any actual evidence to substantiate your adjustments to the actual? Or is it just you're trying to match a standard?
Typically, that's what we see. I know applicants in their briefs will also, when they say that the RNM is high, use 1,500 a unit. It's not unheard of.
Yeah, but that wasn't the question. The question was, everyone wants to make an adjustment. I'm just asking, did you have any evidence to show us on a reasoning behind this?
Other than what I just said, nothing physical in my PDF.
Okay. And with the mixed revenue stream here, are these properties is the retail on a separate title than the apartment?
No, I don't think so.
So if they can't be marketed separately, how can they be valued separately?
This is the way the model values the property, so I can't comment on that.
All right, that's all I was looking for. On the non-recoverables for the retail, which at 3%, is that model generated?
Yeah, all the figures are model generated. Would you like a blended cap rate? I can give you that if you like.
Well, yeah, but if it wasn't created using a blend, then I mean, I know what it is. It's 5.67, but that's not what your evidence shows. You got two separate valuations.
Okay, then.
Yeah, no, that's fine. The vacancy for the retail, how was this described to get the vacancy? What do you consider this?
How's the vacancy described?
Yeah, I mean the basement's had. I don't know if you're understand the history of this, but it has had a couple of different uses in it: retail, institutional, and the present one is. I really don't know what it is now, but I'd like how to describe what it is now. But where did this come from? Is this a retail, downtown retail, or that sort of?
We have it at in our retail bucket in our model. I can't comment it on it further. Not being in retail and not being a modeler, unfortunately.
That's all I wanted to know. So it's a retail, and then is this retail a city number of, or is it just a local number? Like, is it downtown retail or is it just city retail? Do you know that?
I don't have that evidence in my brief.
Now, does your model in any of this workup deal with the historical designation and the impact?
No.
And the same question on the model in regard to the registrations on it for affordable housing. Does your model account for any of that?
No.
And so I know that today all 5 of these are mixed use, so it's that seems to be the theme today. So with apartments and retail. Now on your page, sorry, I lost it. 7. Do any of these have a retail or component?
No.
No, I'm going to ask you about these and just to save some time, the questions will be the same for the other 4 properties to speed matters up. And I'm just going to refer to what my rebuttal document, the longer one, just as my back for this. I could not find the sale of 2390 McPhillips in titles. Are you familiar with the Sabre system?
I actually have not used the Sabre system.
Just a sec, we're gonna have to be able to see those.
Okay, so.
Yeah, I just put in the.
Okay.
Matthew, do you have the rebuttal? Do you have the
His
rebuttal?
rebuttal? Yeah, I got it this morning.
Okay, good. Thanks.
So there's two,
Yeah, these
two of them?
Yeah.
Okay.
So which submission? Rocky, 1 or 2?
The one marked 2, I think. Okay. There's one that has no number and the other one is 2.
Okay.
And it's the start, looks like
Yeah,
this.
yeah, okay, thank you.
So my first question on this property is, was this a title sale or a share sale?
I believe it was a title sale. I can look that up. We get lists of sales that come through. I simply filtered them by date, went through the income and expense mailers. The column said, because not all the sales are good sales. Some of them get kicked out because they're like estate sales, or the sale price is like $1, or for other
Yeah,
reasons.
no, I know that. It's just that when I did a search yesterday, nothing came up on a title transfer. Now I only used the Sabre software, but the Sabre for the board's information is a co-production between the assessment department and I guess is it Manitoba Realtors on tracking sales. So it will give you the title transfer if one actually occurred, and
But it's not connected to the land titles?
yes, they get their information from titles, and it's relied on by the assessor. You'll note that let me show you one that actually what they look like when they show up. The third page, for example, shows that 203 Boardroom sale did show up, and it'll say the class and then the sale type, which is B. And I didn't cut it out here, but it uses the city pucks as well. So it will it would so my question is, I found no evidence for sale, and you're not certain whether or not there was a title or a share sale?
Well, I was able to open our system here, and it says that we have a registered sale date of October 9th, 2020. It says it wasn't on MLS, but I'm assuming because usually if there's a share sale, like we've seen in the past, we don't see a registered sale date on it. It just doesn't show up. So as far as I can tell, it went through land titles.
Okay, well, I mean, the systems aren't perfect, but I just found it's a very common, isn't it not, that transactions are showing up as share sales these days rather than title sales, isn't it?
I can't comment on the frequency, really.
Well, my next question is, I'm not comparing assessments here. We know what the difference is, but I looked at the current assessment, and my question is, if this sale was reliable enough to use as a comparable, why wasn't it reliable enough to use on the subject on the property itself? And it's assessed $2 million lower. My question isn't about comparing assessments, it's about reliability. How can it be reliable for us, for the subject, and not reliable for it itself?
Well, okay, so I know, like you said, we're not comparing assessments, so I can't comment on the assessment. The only thing I can comment on is the sale. I didn't use the assessment in my evidence. I was able to look at multiple year income and expense statements and stabilize that way. So this property on McPhillips that occurs in the list is not meant to be comparable specific. It's simply meant to give an example of a calculated cap rate of an actual transaction.
Right, and but if it were a share sale, obviously there would be additional considerations, would there not, such as any retained earnings, any unclaimed expenses, perhaps taking over debts. And would you have access to that information if it were a share sale?
I mean, I have a registered sale date, so I don't have any indication of it being a share sale.
Is there an instrument number on your sale?
Yeah, I do have one.
Oh, okay, well, that might be helpful. What's the instrument?
522-1887.
Okay. And that's seems to be consistent with the instrument numbers. Now on Burnell, I wasn't able to find this either, but are you aware of the circumstances of 510 Burnell? Who bought it? Who sold it? Who bought it?
510 Burnell. Like, I don't have my report in front of me. I could pull stuff up. Could you maybe elaborate on the question?
Well, it was sold from the estate of Elaine Sigurdsson to one of the companies owned by Smith Agencies, who had a relationship with them. So you weren't aware that they were related parties?
I can see that does check out that Elaine Sigurdsson was sold to a numbered party. I'm not aware of any sort of relationship. Is she on the payroll at or was
No,
she?
no, her family had owned it and Smith had looked after it for years, and they were related to each other going back. Well, Smith is over 100 years old now. So I just, so you weren't aware of this is my question, that there was a relationship.
Yeah, I haven't seen anything about that until you just mentioned it.
And at 700 St. Mary's, I guess my questions are the same as McPhillips. I couldn't find it. If you have an instrument number, that would be great.
Sure.
But then there's the same question. You said it sold for $1,035,000, and that wasn't reliable enough to use for the assessment on it, was it?
I didn't review the assessment. I was simply reviewing the sales in preparation for this season of appeals. So one moment, just let me, I'll get you the instrument number.
Yeah. Well, that help us for the future.
Yeah, for sure. Okay, so we've got a registered sale date here of April 7th, 2020. And the instrument number is 5165984.
Oh, within too many sixes. Okay, great, thanks. So, and again, though, it's assessed at about $170,000 lower than the sale came through. I mean, I'm just looking for continuity here and equity, and wondering if it's a good comp for you to use for another property. Why isn't it good enough to use on the subject?
Again, the subject, the sale, like, I reviewed the mailers, so I can tell you that in the calculation, the stabilized income in relation to the calculated cap rate. I didn't review 700 St. Mary, so I can't comment on that.
The next two properties were part of a portfolio, and are you aware of that?
Let me bring my work up here because I'm flipping around. Oh, Pemmican Groves, they sold on the same date. Yeah, another applicant did bring that up.
That was me.
I know, but in a hearing pass.
Okay.
Beyond the submission point for this evidence, so it was included in the list. But I know that concern has been raised before.
And there was another property in the portfolio that they disposed of. Were you aware?
Again, I can't comment on the other property that's not in my list, but I did learn recently that these two were part of a portfolio. So
okay, and our research is ongoing. It turns out our company handled the sale, so I'll probably have more questions for you the next time we meet.
Okay.
But again, it's a similar question. The current assessment bears no relationship to the sale price, does it?
Let me, hang on, I got a lot flipping around here.
Well, the sale was first one was 22,500,000 and the assessment is 18,828,000. And the other one sold for 7 million, which is assessed at 5,395,000. Again, not comparing assessments. It's a reliability check. If it's good for one, it's got to be good for everybody.
Well, I mean, the model certainly isn't too high on these two.
Yeah, okay. Now 203 Bertrand, well, of course, again, there's the spread between it's assessed at 768 and it's at 925. But did you review the listing?
I had to question that's post-reference listing.
Well, why I'm bringing it up is I don't believe it's post-reference because the listing date came out in May, but they're reporting previous year's gross income at 85,000.
But the listing date is clear and
Right.
several, right? It's post-reference.
Okay, well, let's just think about this.
I have thought about it.
Let me explain.
It's 2022.
No, I'm gonna disagree with you. I want to explain. When the assessor comes forward and gives you cap rates, he has data that's a year and a half out of date on it, right? Because he's using a previous year's income statement to.
But he's not using the 2022 sale on his cap return.
I'm not suggesting first of all, it never sold. It's a listing. This is presented to show you what the previous year's statements provided for the listing were at 85,000. Now, when you look at what the assessor's workup would be, they're indicating that that income, when it was sold, was $44,000. So I'm not saying use 85,000. I'm not saying rely on the listing. My question is, in that period, do you think that it's possible that the income was going to double?
I'm gonna ask him that question.
Okay, well, I'm just clarifying with you, making
I'm
sure.
just saying that this is a 2022 listing.
Absolutely. So that's my question. You have income of 44,000. The following year on a listing, they're saying it's 85,000. So in the concept of preparing a cap rate, is it possible that the deal in 2019 used data that was quite out of date, not representative of what the performance was, that vendor and purchaser actually had a much different NOI in their mind?
So I'm looking at your MLS listing here from 2022. You're saying there's an effective gross income listed somewhere on it?
Yeah, of 85,536 plus another 1,500.
Trying to find that. Is that?
So the second last area.
Okay, yeah, I see that. Okay. All right. Well, I mean, aside from it being post-reference, I don't know where that would have come from. I know sometimes, how shall I say this? Realtors don't always reflect historical performance in their listing for sale. So I can't comment on this income other than pulling it back to the discussion of the property in my table, is that I just use the statements leading up to the sale date. That's what they would have had at the time. If they dreamed up another NOI, I can't answer that yes or no.
Right. I got no questions in 555 Court, and I just put that in there just to show you I was looked up all of them. It's assessed at what, $2,000 off its sale price. 677 Maryland. Are you familiar with this building?
Other than reviewing its income and expense statements, not intimately.
And did you know that it sold for 2.6 million 6 years prior, and then sold for 2.4 million in 2020? Do you think that's a bit abnormal?
If the condition was to remain the same, yeah, I would agree with that statement.
And the listing, which is not post-reference for the 2014 sale, they're stating net income of 204,376 and a 7.9% cap rate at their asking price. Are you suggesting that in the interim, the income dropped dramatically?
Well, I mean, I haven't reviewed this sale. It's quite an old sale. 7.9 cap is typically not something that we see. I mean, this actually predates my time in the department doing apartments, at least. But just to kind of reiterate my last comments, I've reviewed a bunch of sales, and sometimes the figures that the real estate agent puts in their pro forma don't have any reflection on the actual income statement. So I would take that with a grain of salt, that 7.9 cap.
Well, I understand your answer, but I think that it doesn't, the immediate suspicion for using this as a reliable cap for 2020 suggests that some more investigation is needed. Like, why would it decrease in value over time?
I mean, what does it say here? It says they just fully renovated the building. Maybe there were issues going on. I'm just speculating. I just know from living in Winnipeg what certain areas can be like. But it is odd for sure.
Okay. Well, like I said, we're working on it. Well, next time we meet, we'll have more questions. So I'm just trying to, I apologize. We're work in progress. Okay, so I think that was it for my questions on this site. Yes, it is.
That's it. That's it. Linda, any questions?
I don't have any further questions. No.
Yeah.
No, I have no further questions. My questions were answered. Thank you.
Thank you. I have no questions. So Rocky, you're up.
Yes, thank you. So I've inspected this building several times, been in it. It's an interesting building in that this was the Williams Restaurant Supply at one time, and it's timber frame and with the double brick wall. And what the developer did was take the basement and convert it to commercial space. So this unit is in the basement. Well, it's a split level. It's a half a level down. And their hope was to, I think what your first user was, I'm just trying to remember, was low on windows, and then it became a cooking school, and now it's a not-for-profit organization doing local community work. Then they in their development, they added, I think it's 6 units on top of there, and this. So the floors 2 to 3 were shotgun style. And what that means is that they wanted all the units to have a window, and so what the units ended up being was long and narrow. And so you walk into any unit and you would walk generally, I think, yeah, you go into the kitchen and then the dining room and the bedroom or whatever configuration you want. But at any given time, most units were about 10 to 12 feet wide. So it was a different style of setup. But then it gave everybody a window. Then the top was 2-story units. So I think there were 6 or 8, I can't recall. And they had upper and lower levels. And then they also had the parking with it, which was included in the rent and offered them that amenity. The concept of costs, well, as they were doing the renovation, of course, lots of cost overruns. There was some brick failure, as I recall, on the south, I believe it was the southwest corner that needed rebuilding, and it has been expensive to maintain over the years. I take their repairs and maintenance at face value because we've seen that what they've been running into, or the basement, ventilation HVAC problem in the basement has been an ongoing issue as well. So I think the actuals in this case are actually very, very reasonable, considering the age of it. And also because it's an historical designation, they do have responsibility to maintain that brick issue that they've had problems with over the years. To tell you the truth, when we looked at the statements, I totally disagree with the assessor. I know what the management fees are. They had to spend a lot of time on this, and the maintenance repair has always been up. I actually took exception to the professional fees. They seem to me to be a bit too high. And so when you see our workup of where we had an NOI of 285,000 versus the 258,000 they declared, that was our stabilization. And it was based on inspections and experience, not ratios, because there's no such thing as a ratio in a building that's 100 years old, 115 years old, and it is what it is. And that's kind of the thing with these buildings. They don't fit. So we're using that actual income, and probably the area that impacts like the breakdown. Sorry, the breakdown on it for us was looking at the rent being generated by the non-residential, which is 94,000 gross. Turns out it's about 56,000 net. And that's just by allocating a percentage of the costs to them, which the calculation is shown below. And the remainder of the income would be attributable to the residential. Now, one of the things that I failed to ask the assessor about this is whether in the parking breakdown, they had a split between residential parking and commercial parking. And I can't ask them that now, but my knowledge that it's all residential at this point. But I suppose we both, neither of us have presented a parking count on that, because it would make a difference in the allocation. Now, are the historic write-up is on page 5. And oh yeah, I spent a lot of time in the building prior to renovation too, because I used to buy restaurant supplies there. So I've had pre-inspection and pre-renovation and post-renovation inspections. And so the actuals, which we've adjusted upwards from 258 to 285, and our cap rate, the thought behind it is on page 2. We've not run dual revenue streams, because you don't do dual revenue streams for buildings like this, because they can't sell half the building. Investors looking at the whole. So the prime rate, which is the lowest we'll see, is based on our Collier's model, which we have at 5%, and that's shown on page 22 and onwards. And page 24 is of some note. You're gonna hear this from me an awful lot. Direct capitalization is dormant, because there have been too many deals where people aren't purchasing on the basis of direct capitalization, or it's been misapplied. The reason capitalization exists is not for assessors and appraisers, it's for banks. It's to make sure you have enough money to pay your loan. And if you ignore that fact, you're not doing the income approach. You're doing a speculative valuation. And as far as I know, the Act doesn't may allow for speculative valuation, but then it has to be declared as such. It is not. We're using the income approach. We're bound to use income-based thinking. And we've given you this chart on page 24, as well as the Collier's cap rate debt report, which follows on page 29. And what Colliers, as an international company, is trying to remind the market of is that you still must relate your cap rate to the cost of borrowing money, the spread. And that's called a band of investment or a mortgage equity method. We have to return some sanity to these rates. Now, in my critique of the assessor, what I was trying to get at is that oftentimes these properties get sold with a higher than RTB allowed increase coming through, or post renovation sales, where the vendor and purchaser knew that the NOI that they were going to use for their sale wasn't last year's income. It was a different number. And that's the number we need to chase, is what at time of sale, what was your expectation of next year's revenue? It's not post-reference. That's when the meeting of minds took place. To further demonstrate, and this is the rebuttal material, just a one-page one, it's just called rebuttal.
Okay, let us get there. The Canadian mortgage bond unit.
That's correct. Now, what this is the box shows that April 4th, 2021, and I don't think I'm going to care about post-reference comments on that. I think the 4th might have been a Monday and the 1st was a Friday. These were the mortgage rates in place. So you see that a conventional commercial mortgage, 3.5 to 7.5%, and the CMHC guaranteed is 2.4 to 4.5. Now, the CMHC always comes with restrictions. There's certain, not every property can get a CMHC mortgage. There's things you have to, a status you need to have to get it. And also there's an application fee. I don't know if anyone's ever mortgaged a house, but what I think the residential one is close to $10,000 these days. You pay, they'll amortize it into your loan and everything, but there's a fee attached to it as well. So it's not a pure 2.5%, 2.4% rate. Below that are, what I'm doing here is doing the mortgage constant, which demonstrates that if you have the years of amortization and the rate applied, how much the loan is going to cost you per $1 million. And I've just ran a bunch of scenarios, and you can see that the numbers range from a low of 5.4% to a high of 7.3%. So on the best possible outcome of a 30-year term at a 3.5% mortgage, it's still a 5.5% return you need to pay your rent. I'm sorry. I have a lot of things in my mind, sorry. To pay your mortgage. If you're paying 5.4% in your mortgage, why would you buy it at a cap of 5.3 or 4.9 to lose money? You know what that's called? That's called creative financing. Something else is happening. And that's why I put the market value definition below, but there's on the page section 5 of the market value definition. Price represents the normal consideration for the property sold unaffected by special or creative financing or sales consent sessions granted by anyone associated with the sale. And below that is the Municipal Assessment Act definition of value. And what we're seeing in the market is when you look through, for example, the sales the assessor had, aside from the fact of the date where they weren't done at date of sale, we also need to understand, was there creative financing involved? were these purchasers able to take over a good mortgage at a lower rate, or did they go to the market and have to get a new mortgage? Because that's going to impact the cap rate. Because even though we don't care about cap rates, when we calculate our mortgages, there's going to be an impact on the purchaser. Because a 1 point spread in cap rates, sorry, in interest rates, it turns out to be a 50% increase in the interest that you have to pay, which has to be covered by the income it generates. And that's what we're trying to do, is just get back to normalcy. 4% rates don't exist except in speculation. Speculation could be something as simple as, I know there's a rent bump coming next year. I'm factoring in today for what I'm prepared to bid for you, but I still got to get a mortgage. Now, when we're doing tax assessment, we don't have the option of saying, I'm going to get rent down the road. We're not. I mean, if we know it and then we can declare it, you can adjust for it. And if you don't know it, don't use it as a comp. And what the caller is, and I'll say again what I keep saying. These aren't my words. This is our company that put this together, just to educate the user, our vendors, our purchasers. Don't understand how investment works. And if you're going to go off and pay too much and you've got creative financing, that's your issue, not ours. Now, as this relates to the subject property, we start on, and I'm going back to my page 2. The lowest Collier's cap rate in multifamily is 5%. Now, what we've done is shown you how we adjust it. And the reason we do this is, let's just say you disagree with me. It happens. And you say, I don't like that. Okay, take it out, adjust it. But it's a numerical base for thinking about it. It's not a mystery. So, maybe Mr. McIntyre at one point understood the model. Maybe you didn't. But the point is, you don't come before this board and talk about the model without showing someone how the model works. I think that's wrong. It lacks transparency. Nothing against the assessor. He's got to do what he's got to do. What we're trying to do is show you how a model should work. And if you disagree with it, you make a judgment. At least I think it's the quality of giving you the respect that you need to make a decision, not a guesswork. So if the best rate you could have was 5%, first of all, what we look at is a -5 for the historical designation. Because in addition to the physical restrictions on what you can do with it, they also, in order to get some grant money, had to make a certain number of suites affordable. So they can't increase the rents on them. You're going to be stuck with the units. Now, at the time they did this, I believe the number they had to work with was $640 a month. And then he would be subject to only RTB increases at that point, which is a far cry from, I think the assessor has $1,000 average. And I have no reason to doubt those numbers for the unencumbered units, but for the encumbered units, and I believe there's 6 of them, that's not going to happen. So a purchaser is going to look at this and say, I don't like the upside there. And I think it's a major factor. So in our mind, that was 5 points, and the 5 points translates to about 0.2 of a percentage point. So if you disagreed with that, for example, and I said 6.67, then you would say, well, then it's 6.47. Just that's how the math works. Financing is a 2-point deduction because all Collier's cap rates include closing costs, and that's not part of the transaction. It artificially raises the purchase price. The next issue is the coverage ratio, and because this is a partial commercial building, no loading access was something we identified as being a problem. There is a back lane for former rail loading. They don't control that anymore. And it's just an ease of use for commercial properties as well as residential drop-off zones. It's a very, very minor deduction, 0.05 of the percentage point. The design and layout is not optimal. The bachelor units, but I think more importantly, the shotgun style. It's obviously not a family place. Now where it's located, target market is not necessarily family, but markets change. So in the long run, the assessor addressed this. I counted it 2 this morning. In the long run, the investor is looking at a lack of adaptability. So that again, a minor deduction, but that amounts to 0.15 of the percentage point. Year built, that's easy. Because it doesn't matter what you renovate, you have not changed the foundation, the framing, or the envelope. You've repaired the envelope. You've done the interior and you've done the roof, redone the roof. And that's 3 of the major points in a building cannot change. You're not taking that out of it. You're not getting an effective age of 1990 from 1907 unless you replace the foundation. These things this is on a cut stone. And I don't know what's under the stone, how far down they excavated. It's not rubble. And the framing is timber, which is actually very good to work with. But the problem are the craftsmen today to work with the timber and the product. It's extremely hard to source I think those are 14-foot centers. I don't know if we even grow them anymore. To do the posts. Beams are 10s and 12s. You can still get those, but not in long spans. Quality and condition, it is good, but it's not perfect, as to be expected. And then the income growth potential, which is where really the serious problems is the low income apartment units. And the retail is not desirable. We've had 3 or 4 turnovers in users, and really nobody wants to be there, unless and like I said, the last user they got in is institutional and a nonprofit organization. The location works for them right now, but I mean they're budget constraints, and that speaks to tenant strength and income stability. So those are our concerns with it. And so overall, we think the 6.67 should be applied to the whole thing. And our workup is shown on page 1. Again, we're working hard to clean this up, but we were based on what we thought is the value was $3,597,000, and for commercial 636,000. I'm just trying to remember if this is still under appeal at municipal board. Do you know that, Matthew? Is this open? Muted. He's just checking.
Just checking. Let's see. I see a pending 2018. I don't see anything in regards to 2020.
Okay, all right. Last 2 things to point out. At page 38, remember I was earlier I was talking about my rebuttal too about the printout, and those are these outputs that come with the green headers on them. Page 38 is from the same, I exported these to an Excel, so this is the same database. And I was showing you how what they give you. They'll give you the parcel ID, that's the roll number, and then the puck beside it. In this case, it was office, the year built, and the dates and everything, and then the instrument number there. And when Matt was giving me those instrument numbers, I was looking at, these are all 5 in the 5 million series. So that's why that makes sense. That I don't know why they didn't show up when I searched them, but this is what we have for our sales. This particular one just had to do with office. Page 41 is our non-recoverable And these were taken from, these I compiled myself from Collier's managed properties. These are the non-recoverables by property, and I'm this one was done up to 1,080. I'm now up to 2,100. So maybe the next time you'll see more. The average at this point was 11.47, and you'll see that that's impacted by some of the large ones, and that will be issues where they had a major tenant turnover and there were commissions and repairs required, a tenant's cost for it, and the mean is in the neighborhood of 8%. And that's likely more accurate. So what the city has been allowing for non-recoverables is 3%, and the market is 8%. And that would be a mix of I mean, generally it's things you can't get from your tenants, and like accounting professional in a commercial capacity, that is, and the commissions, all these things we don't normally deduct because for years there's been a standard allowance and everybody was happy with 5% and 2% because that was very, very indicative of the market. And in 2020, the assessor said he didn't exist anymore, but he has 2%. Well, they had 2%, and now it's 3%. It's not those numbers. These are from an organization, a professional property management organization. These are what the financial statements say. That's it for this building.
Thank you very much. Matthew, any questions?
Yeah, just a couple. So just going down to, sorry, page 2, you have a table here with property rights financing, closing costs, etc. This technique, is this something that came from like the Appraisal Institute, or is it something that a tool that you came up with yourself?
No, it came from Collier's. It's part of the background for the cap rate study as well. So the first time I saw this was in 2008, and from the Collier's reports, they took strengths and weaknesses in the caps and broke it down into 23 categories. So this is something we've done for valuation for at least 14 years that I know of. And the same people who did that breakdown created the cap rate tables that are so glibly referred to by people without knowing how they're made. And we have that on page 26, 27. Now, in the original incarnation of this, there was inferior, superior, or neutral given to it. And what I did about 10 years ago is working with our appraisal people across the country, is we started to look at weighing these. How important are these? And then we consulted with the investment people, Don White and Brian Taglio. And their answers were really simple. It's really all about the money. Some of these issues are minor, but it's money, and how does it relate to money?
Okay. So just in regards to your methodology in calculating cap rates, are you aware of any other applicant or agency coming to this board using interest rates as opposed to direct capitalization?
Well, I think that of the people who come before this board as of today, none of them are affiliated with the brokerage company or as to Montgomery. None of them actually work in sales. None of them deal with purchasers and vendors. And in that respect, I think what we have is a deeper understanding of how the transaction is created and the problems with it. I mean, without trying to, I'm not saying this to be funny, but everybody knows, you know, about priests dispensing advice on marriage. And that's really what we often see from a lot of practitioners, that they look at the numbers and they see this statistical relationship, but don't deal with it. I mean, what I like to be able to say is we were involved in this deal. We were involved in this deal. This is what the vendor had in mind. This is what the purchaser had in mind, and chase that routine. So, you know, and then the other thing is do they have access to these things? Remember, there's this big debate, and you can stop me anytime. There was this big debate last cycle about Ward Avenue and what did it sell for and what was the cap rate. And one company said it was this, and another one said it was this.
I think we all heard about Ward.
Yes, we have.
Over and over again.
But exactly. But the point is we sold it. So I don't know if I put that one in on my report. That's what it actually sold for. We had it the last time I presented. And if you're going to come off as an expert, be on the spot. And that's why I'm working at Colliers and not somewhere else. I like to be where we're actually working on a deal.
Okay, those are my questions. Thank you.
Thank you. And Linda
I don't think I have any further questions. No.
and Gail.
Nor do I. Thank you.
Nor do I. So that concludes this property. Does anybody need a break?
I assume the rest are going to go a little more quickly.
Yeah, they will guarantee they will.
That just because I have something coming up after lunch, and I would need to contact them, but I'll wait until after we finish the next one.
Okay, fair enough.
My meter's at 11, so
Oh, wow, I gave you a
That
12.
doesn't mean we're finished.
motivation.
I like that.
Okay, the next property on the docket is 228 Notre Dame Avenue. Any preliminary issues?
Yeah, I just wanted to check. Now, this recommendation is to change just the class 60 to 40S, right?
Yes.
Okay. And do you know?
Well, we have to read this into the record before you ask any questions.
Oh, yeah.
We haven't even identified the roll number.
Okay, no, all right.
Okay, Matt, read the information into the record to the point where you get to the recommendation.
Okay, sounds good. File number 22-2670, roll number 13052175000, 228 Notre Dame Avenue. Assessed value to income streams 5,929,000. You see the property description. There's the metrics of it. Classification was under appeal. So I reviewed the 60T classification on the property and made a recommendation to change it to 40S as per the Municipal Assessment Act. We had a similar situation on 265 Portage where we did the same thing in regards to a similar occupier. The occupier for this property is a company called Needs. They provide Canadian education programming to newly arrived citizens, not for profit. Falling in line with what we did for 265 Portage, that qualifies under, 23(1)D is owned, held in trust, and used by a college or seminary of learning to a maximum exemption of 1.62 hectares. So staying consistent, I changed the classification on it. Do you want me to keep presenting, or do you want me to just stop there?
Oh, I'll ask Rocky what your feelings are about the recommendation.
No, I actually, that's what we were looking for is the change to 40S. And is this just effective with the 23 rule, or do you know if they're planning on doing it as a date of application? Because we filed this, I think last year.
Oh, okay. Like, I mean, the only control I have in this capacity right now is in regards to 2023. I know on a supplemental basis, we can go back, I believe to the beginning of 2021. So I'll go back and talk to Brian about that.
Yeah, well, no, what happened is they have 3 buildings and 2 of them were in, I think retail or office or something. So they processed the change as of the date we made application. And then because this one's in multi, no one got back to us.
Okay.
So I'm just wondering if you're going to go back to that date.
I'll have to go back and review the file and talk to Brian about it.
You could.
Okay, I'll if there's not anything else, I'll just keep going here. Page 2 is a request for income information. There's subject sale history. There's a dollar sale with a sworn value of $5,150,000 in the end of 2017. We've got our income value summary on page 3, showing our modeled parameters for both the office and apartment aspects of it. So page 4, that's our average rents for each respective unit. $1,028.03 for the multi, $12.22 for the office component. Rent comparables are found on page 5. General downtown area. You can see the average monthly rent per unit falls within the bottom end of the range. 3 of the 4 comparables have bachelors or subject properties, all 1 bedroom. Comparable leases are found on page 6. I believe our rents for the commercial component are highly similar, if not exactly similar, so I'm not going to elaborate on these. And then we have our cap rate tables, which we on page 7 and 8, which we discussed last property, so I'm not going to get into that. Page 10, that's the excerpt from the Municipal Assessment Act. And then we have our mailer beginning on page 11, showing the property. So it's got a really high repair and maintenance on it. $182,901. That's page 11 of my brief. So we're looking at that on a per unit basis. That's $3,976 per unit. That's roughly double of what we see at the higher end on the property. So I wasn't able, like, it's highly likely that there are capital repairs on top of yearly repair and maintenance in order for them to be reporting that figure. So I wasn't able to come up with any sort of breakdown or anything of where those repairs were lying in the property, or was it in residential, was it in commercial? So I just went with the model on this one. When you're looking at the mailer on page 11, you can see that everything's combined, so I wasn't able to tease it out or make a change. Our value is 5.9 million. The dollar sale had a sworn value of 5.1 million at the end of 2017. So in an appreciating market, It's higher, but it's not unreasonably higher, in my opinion. Page 14 just shows a quick snapshot of what I took from their website, the needs, the classification change back up there. And then just some pictures I was able to find online. They're old pictures though. One on page 18 is timestamped January 2008. So unfortunately, that's the closest I have to knowing what the inside looks like at this point. So I just went with model on this one. That's my evidence. Thank you.
Thank you. And Rocky, any questions?
Yeah, on page 2, you talked about the sworn value sale. Do you know anything about it, or are you putting any weight on it?
No, not really. It's just, from my understanding, it's someone has to put a value on it, so when they're doing the transfer tax, they know the amount to charge.
Okay. And on your workup on page 3, I'm just kind of wondering. I'd asked you the question earlier about the vacancy rate of 6% on Princess, and here it's 12%. So is that because you're calling this an office?
I'm not sure. Actually, not being as familiar with the office side of the coin, I just spit out the model, spit out the parameters, so I can't.
The last one was headered. It was called retail. This one's called office. So we're assuming that this is model generated then.
Yes.
Okay. Does that mean if a user changes from retail to office that you will change the assessment?
If like the occupier.
Yeah. These things change a lot, right? One day it could be a retail, one day it could be an office.
Yeah, I get what you're saying. I'm just I'm trying to.
You have no mixed use category. That's what I'm getting at to you.
I'm not sure. I'm just checking to see if there was an override put on the vacancy. Actually, no, there wasn't. So that's model generated.
And you talked about repair and maintenance being 3,900, which is double the high end. For Princess, you were able to suggest an adjustment. What would be wrong with suggesting an adjustment here?
Well, with an extra, there's an extra $1,000, it'd be much bigger of an adjustment. Now, while we wouldn't be including that additional $1,500 a unit, if I was to make an adjustment on the repair and maintenance, it's not like that additional $1,500 a unit doesn't add value somewhere. Like it doesn't just, while it might not appear on a yearly pro forma, there's some kind of large amount of capital improvement.
Yeah, no, I in this case, we call it capital, which are on the right path. But are you suggesting that 1,500 is probably better number?
I'm saying typically, I think that's a pretty fair number to go with, especially considering the actual year built of the property. It's on the higher end of the adjustment scale. I think that perhaps we're on the same mindset when it comes to $1,500 a unit.
Yeah, okay. That's and I think all the rest of the were you aware what this was before it became an apartment?
No, I was not.
Okay. I think we've asked and answered all the rest in the cap rate. Is that fair?
Certainly.
Okay. Thank you. I'm done.
Thank you. Linda?
So just to be clear, the assessed value that you're coming with is 5,548.
For the residential component, and then for the commercial component, 381,000. And I've made a change to the classification. on only the commercial component to reflect what's going on in there.
Thank you.
Gail.
Thank you. So my question relates to the proposed classification change. Can you describe the classification change that you're suggesting? Like it's an exemption from taxation.
No, it's an exemption from school taxes.
Yeah.
So it's on page 10.
Mm-hmm.
I have an excerpt from the Municipal Assessment Act 23(1) D, owned by or held in trust, used by college or seminary learning to a maximum exemption of 1.62 hectares. So this place, it's like an education, not-for-profit education facility for new Canadians. Therefore, it would fall under, I believe they have like a curriculum, teachers learning about Canadian classroom, English language skills and development. Further description can be found on page 14. I took an extra, there's a lot on the website, but I know the applicants and I have worked on another property where a very similar classification change was made for a very similar occupier. So I didn't think it would be much of an issue on it, and it's not. So basically just based on the occupier in there and its use, it falls under 23(1) D.
So can you describe to me how it is owned by Needs? That's the nonprofit organization. How is this property owned by or held in trust for Needs? How do they hold the property?
Well, they don't own it. But they're occupying it, and it's used by college, and this would fall under the seminary of learning aspect of it. So it's used as a seminary of learning for new Canadians, and falling in line with what we did for 265 Portage. You'll see when we get to that one, that space has that classification. I made the change.
Okay, so I have no question that it's used as this learning facility. Just the question in regards to the other criteria that it's either owned by or held in trust for. What document have you seen? Like what type of document does Needs have that demonstrates that the property is held in trust for them or is owned by them?
I don't have any documentation in that regard.
Okay, thank you. Just then one more question in regards to that. How does assessment then, how would you track them being in that property? As the applicant indicated, properties, this type of space changes a lot. One day it's one thing, one day it's another thing. You know, a different occupier in it. So how would you track, what do you have on file to track that user is in that property, given that you're proposing to change the classification and the tax liability?
Well, we have their occupancy permits, and then we look into who the user is, and then we make changes as appropriate.
Okay, thank you. That's all my questions.
And just a quick question. Are they exempt from business tax?
It says they're exempt from school taxes. I don't know actually if they're exempt from business taxes or not.
Okay, that was my only question. Okay, Rocky, you're up.
Happy I didn't answer those questions for him and interrupt.
Well, because you can't.
I know.
Unless I direct it.
I can stop. I can't stop myself sometimes. But all nonprofit are exempt from business tax, and the type of ownership there was a case called Wassa,
Right.
where they established that a leasehold estate is a form of ownership, and therefore under the act, they can have the exemption as a owner of that estate. And that's how that they meet the standard right.
And a brilliant lawyer.
Did they? Did no. The other thing that's funny about the questioning those is that in 2012 this was appealed and the board erred on classification and they granted school tax exemption to the entire complex. And the assessor picked it up a year later and was unable to go back and fix 2012, but then fixed 2013 by supplemental. And in 2021, they finally did the municipal board appeal, and at that point they actually tried to recoup the change back then. So it was there was a lot of litigation going on about the amount of the liability for this error and who's going to bear it and who's going to pay the legal costs. So that's why that goes into the sale price too. So it was never worth even thinking about that. But it was eventually resolved. And we do agree with the class change. This is what we requested, just changing the class 60 to a 40. We made that application, I think last fall. And normally you can do it outside of a hearing. And it hadn't happened yet, so we filed for it. The areas where we differ, the biggest one is the income, because this is the actual income, and we have it in some areas of agreement. If you look at page 3, which is the same thing the assessor has presented to you, the income showing here is almost 25,000, but $100,000 in interest is included, so that's got to be backed out. And then the maintenance and repair at 182,000 on our page 1, we did a recalculation at $1,500 per unit, just like we were talking about. The original number was 4,100 a unit, so that changes the 182,000 down to 66,000 for a total net income of 241,000, I think 800 or something like that, being the actual. And this wasn't done because I wanted to meet a ratio. This was done because we knew that there were costs that I don't want to say are capital in nature, but they don't go on the operating statement. Apartments have varying depreciation schedules, and there's short-lived, medium-lived, and long-lived items. So these would be greater than medium and less than long. Best way I can say that. So but we did this by investigation. So the number we came up with in total income is, you look at my first page, it's 217,900 on the multifamily and 23,900 on the commercial section of it. And I the assessor's got a lower number than that. That's fine. And so you can see our big difference is 217 to 220 to his 299, and ours is the actual. And I don't see that there's any reason one can't say, well, we should go with a model or a rate. Again, you can't change what it is. This is where it's performing at. And we have stabilized the one issue that was a little bit out of whack. And the expense ratio we end up with is I don't understand why this math is so much different here. The assessor's saying 43% expenses. Yes. Oh, okay, that number's expense ratio. Yeah, that's wrong. I see. Just disregard that number. Then we go to the cap rate. And the issues on this are somewhat similar to the last one, being this is a historic designation. In this case, there are no units that are impacted by a affordable housing initiative. It's just the designation, but it has different problems. Oh, there's an error. They didn't put the closing costs in this. Okay. The configuration, this was originally an office building, and you can see on the historical statement on page 6 that it was an office tower. It's converted to multifamily, and the difficulties in that lie in reconfiguration and dealing with where the beams are, and does it work for multifamily. It wasn't planned or designed for it, and it's the adaptability. And again, so we said the optimal was a 5, and this we rated a 3. So that's a difference of 0.1 of a percentage point if you disagree with me. I just want to put this all in perspective. Essentially, these issues all are about a 0.05% points on our concept of a cap rate. Being all 1 bedrooms is then what ended up happening, because you're dealing with where the posts are, and that is a negative factor. Issues. This was a very good renovation, and it's a really distinctive looking building. They did a great job on the outside, but it's still 111 years old. And the retail part of it is always tough with these buildings. Everybody thinks it's a good idea to put retail on the first, but that's only because people don't want to rent first floor apartments. But retail on the first is just not a good pair. It's just not a good market unless you can find a use that can generate high income and the like. Probably why a lot of people try to get food service operations or banks on first floors, something where there's people traffic. But every corner can't have one, and that would be a negative factor, not a positive factor. So again, it's the same issues as the last one, and we're looking at roughly the same cap rate and applied to all parts of it. Now the number then we came up with is 3,229,000 on apartment and 354 on the school exempt office portion. And again, I'll just repeat, it's actual income, and which is I think doesn't really it shouldn't really be contested much, and are looking at the caps. I mean, these are not good investment properties. These aren't desirable. These are second or third level market properties. These historical buildings. People aren't rushing out to buy one of these because there's the great worry of building that old. What costs are you going to look at down the road for anything that needs to be repaired or maintained historical? That's my presentation. Thanks.
Thank you. Matthew, any questions?
No questions.
Thank you. Linda?
So you're using the actuals?
Yes. With the adjustment for the repair and maintenance down to 1,500 a year.
Okay. Thank you.
And Gail?
I have no questions. Thank you.
And I have no questions. So that concludes 228 Notre Dame. The next one on the docket is 265 Portage, and Matthew, you can proceed.
Okay, thank you. One moment. Okay, file number 22-2009, roll number 13096158700, 265 Portage Avenue, 2023 combined assessment 11,970,000. Older building on Portage. It's had some renovations. It's got commercial at the base of it. You can notice that it has the institutional 40S classification. This is the property I was referencing in the last property. So we're making the change to be consistent on the last one. Page 2, request for income information. They've been good with returning their stuff. The page 3 shows our modeled workups and our value. Page 4 shows the average suite and net rents applied by the model. Page 5 is our rent comparables. Oh, you can see that we fall within the range of other properties in the general downtown area. Comparable 2 and 3 have bachelor units. The subject does not. So page 6 shows the comparable lease information. I believe this is a case where the net operating income isn't in dispute so much, and so that I think we're lower than the applicant, so I'm not going to really touch on this too much. And because it's a cap rate dispute, unless something's changed, page 7 and 8 are the cap rate. It is the cap rate information we've already discussed, and then page 10 shows 2020 income and expenses at 75 units with the reported effective gross income. Total combined model income difference is 19,000, and the actual reported expenses are included of a 9% management and a high R&M. So it looks like we're low, but I'm not asking for an increase in the net operating income. The pictures are on page 15. And they just show an ad of the property showing that it's been redone, looks over Portage Avenue. I have not been inside of it. And then starting on page 19 shows the classroom space for the commercial area at the base. So just, yeah, that's my evidence. Thank you.
Thank you. Rocky, any questions?
Why didn't you provide the sale?
The sale?
Yeah.
Well, the model didn't kick a sale out, so I'm not aware of a sale on this.
Oh, okay. So what date do you have for renovation on here?
Oh, okay. Let me pull this up. Oh no, I gotta make sure I'm on the right bit. It would have been in the past 10 years, I believe.
Yeah, it should be.
I got notes from 2012 indicating some renovations. I don't have an exact date.
Okay, that's fine. I don't have to dwell on it. And this is I'm only reading on my little screen here. So this is 2 buildings, correct? That were adjoined.
I believe in hearings past you've mentioned that.
Okay. And what about the parking?
The parking.
You didn't have a separate revenue stream for the parking?
No, we don't.
Okay. And you're aware that there's inside parking in the revenue?
I believe that is for the residential occupiers.
Right. And are you, when you're looking at the rent that you're applying, you're not considering the affordable housing portion of it?
No, no.
Okay. And what was it prior to the renovation?
Well, I wasn't with the department at that time. I didn't look into it. I'm looking at
Okay.
it. 2021.
Okay, so but you essentially though, you have a building that was built, two buildings that were built 1904, 1906, and you're now saying today that it's a 4.7% cap rate on that.
Yeah.
And I take it, is that because the department changed the effective years built?
Yeah.
Okay. And what was the extent of the renovations, do you know?
Well, I can tell by looking at it, they've done a whole heck of a lot. They've redone the interior. I could imagine if it's, over 100 years old, mechanical would have been done as well. But like you said, the foundation is older. But I wasn't involved in making the change on the property, but the renovations were extensive. That's apparent.
Yeah, I just look at when you have an effective year that bumps it, improves its age by over 90 years. I question that, and that's why I'm asking you this. Is that's an awful lot, isn't it? And would that make a difference? I guess on your model if it had an older effective age?
Yeah, it definitely would.
Okay, those are my questions.
Thank you, Linda.
Just a clarification, and this goes for all of yours. Where you've got the shortfall rate, you've got $12. That should be a percentage, correct? We're talking.
Let me see.
Am I reading this wrong?
No, it should be square.
Square foot.
Yeah, total.
Oh,
Yeah.
Okay. Never mind.
Yeah.
In regards to this property, the portion that is classified as 40S, how long is that being classified in that way?
I know this was an issue under appeal, either a cycle ago or 2 cycles ago. And upon inspection of the premises, we made the change. So I would say in our system, probably within the last 5 years to be safe.
Okay. Thank you. That's all my questions.
Thank you, and I have no questions. So, Rocky, you're up.
Yep. Well, I think this is essentially just a cap rate issue. We have incomes that are they declared 628,000, the assessors at 624, and for some strange reason we worked it out to 643. And I think that had to do with our stabilization of vacancy wasn't as severe as the actual vacancies, and that's where the difference is showing up. I get to answer some of my own questions. What was the previous use? It was Winnipeg's largest pigeon coop. I don't know how many of you remember this, but I think the Dominion News was in there in the 70s, and that was the only tenant in the building as it slowly lost all of its users and just went vacant. And Center Venture took it over. And the next question is, how much did it sell for? $10 to this developer. And then he was funded by, he got some funding on the affordable housing initiatives. There are, again, 6 units that were at the time priced at $635 a month. I know all this. I did a lot of work on this property and valuation and the GST portion of it, and the numbers we're showing you today are utterly consistent with that work. We don't do a different number for financing or GST than we would for tax appeal. It's very strange how close that number really is, and I didn't even do this work up. What was the other question I asked? Oh yeah, the configuration, it's two buildings and they're at different levels too. So they don't flow right through. So there's stairs that go up as you go from one to another. They also added on the interior some new units on the top. This is the same owner's 230 Princess. So it's the same concept. They put a couple of new units on the top, on the rooftop, and added them to the building. There's inside parking, and it's really tight to get in. And the extent of the renovation was the interior, the HVAC, and those ugly steel balconies. I absolutely hate them. And I get, well, you go out there and I gotta go inspect, and I have to walk out in the balcony. I can't do it. They're scary. And I don't even get why they put them there. I guess it's probably for smokers, because they're steel, but they extend onto portage. There's nothing to see, and you're on the gangplank coming off the pirate ship. So it's kind of the way it feels. So getting to the main issues, the cap rate, again, it's got historical designations on both. It has restrictions on several units for maximum rents they can generate, and it has the first floor office rental. And these buildings, as you can see, there's a pattern here. They're all getting the institutional nonprofit users. And by the way, I think you're going to get an application for exemption on 230 Princess shortly, because that's who's using. That's the only interest you can generate in these, like a retail user. Office user, that's really not where they want to be. Those aren't good tenants, and so I've pretty much described all the issues with it. There's historical. We only dug up the one on one of the buildings, but there's historicals on both buildings. And the 6.75% cap rate, again, we had pictures and we didn't put them in here of what it looked like before. We've been having this debate with the assessment department for quite some time, is how you take a building built in 1904 and 6 and say that it's a 1999. That's an impossibility. So the previous two cycles of assessment, I think they're still in case management. We're still trying to resolve them. The issue is just all the same. It's the cap. This isn't a good investment property. This was, like a lot of these historical buildings, the genesis that came from Center Venture and the desire for taking the old stock of buildings, finding some funding to help people renovate and provide housing. That's not market driven. That's policy driven. And that's why we're adamant on these cap rates. If it was market driven by an investor who wanted a return, yes, rates would be more aggressive. They'd probably be in, the high fives, mid fives. But that's not how this project started, and that's a major problem with it. Thank you. That's my presentation.
Thank you. Matthew, any questions?
Did the property have a historical designation on it prior to it being completely renovated?
Yeah, the original historical designations were done. Well, you see, this one's listed at 2008, but most of these were done in the 1970s and 80s by a guy by the name of Rostowski, who was given a list and he did these write-ups. Then they were put on the old list or inventory. And then when they changed the way they designated them, they kept them forward. So, but this is a long time registration. And that's one of the reasons that the only proposals that ever came forward when it was the pigeon coop was demolition and maybe put up a parking structure. And nobody wanted the civic politicians, of course, didn't want that. So it just sat and sat until they got this proposal going. You know, and then they give somebody funding to help them do it, sell it to them for $10. You know, we should do the cost approach on this. Because it's going to come in lower than $9 million.
Okay, so just to be clear, it's just the historical designation on the property didn't stop it from being totally renovated.
No, what it meant is, in this case, because it was a basket case, the committees were far more favorable to things like the steel balconies. You won't generally see someone who's got a historic designation get approval for something like that. But the developer wanted to put them in, and you know, it's the only deal in town, so they took it.
Okay, those are my questions. Thank you.
Thank you, Linda
I have no question.
and Gail.
Just a question in regards to the tenants. You described the type of tenant that they would be looking for, the owners would be looking for the space, and often nonprofit tenants for these type of buildings. And so in regard to the tenancy agreement with those tenants, who's responsible for the property tax? Is that built into their rent, or does the
Yeah,
tenant pay?
most of these are gross rents because the nonprofits like to see a finite number, and because of their funding,
Right,
and so the you know, commercial one will be your net rent, and then CAM costs for taxes, which could change. So that's one of the limitations on the earning potential, is because the property owner has to absorb the tax increase in its net income. So one of the things of interest is that there's a circular argument happening here. If we look at historically what they've been paying for property tax, or do we look at what the city is proposing for an assessment, which is a variance of $2 million, and then the taxes are higher, do you do your valuation that way, or do you do it with the old numbers? Now we use historical numbers. So in that respect, I think that there's, you know, if you're calculating it on a proposed assessment, it's worth less. Which again ends the circular argument, because you're absorbing the taxes, and that happens more. But in this case, the commercial portion is rather small, so it's not a major impact. But we do have buildings like this where it is an issue. I'm thinking of one now.
yeah, with regards to this particular property, and going back to the question that I had asked the assessor about when the change in tax status, in classification status occurred, the portion for that portion of the building would have been reduced, right? So I'm just wondering, is that passed on to the tenant, or is it realized by the owner?
Yeah. Okay. That's a case by case situation. I have to say that I've seen both happen, right? And it's I can't comment on what this building did. I know some owners who would say I'm passing that right on to the tenant, but the difficulty in that lies in the denominator, in the numerator, because usually you get a lease, and City of Winnipeg's involved in this one, where everybody in the building has to pay their percentage of taxes based on the percentage of floor area that they have. The city's exempt, but their lease says they pay taxes based on the percentage of the floor area. So the taxes drop $2 million. They don't get the benefit of it. By contract law, it has to go to everybody in the building unless you can change all their leases. So I hate to put all these guys on the spot as to what they do with it. I know some keep it.
Okay, thank you. That's all my questions.
Thank you, and I have no questions. So the next property is 279 Portage Avenue, and Matthew, you can proceed.
Okay, one moment. File number 22-20 2743, roll number 13052301500. 279 Forge Avenue, again, mixed use, combined assessed value 7,284,000. Actual year built 1911, had some renovations done to it. Page 2, request for income information. They've been good handing in their mailers. There was an older sale from 2016 on the property. 2.5 million dollars. Page 3 shows the workups. For the interest of being efficient, I noticed between our brief and the applicant's brief, the net operating income on the commercial side, they're within a couple $100 of each other, so I'm not going to dwell on that. You can see our apartment workup. It's all modeled based on their income. So then we have on page 4, we've got our market average rents for the units. You'll notice that there's a 25% vacancy on the commercial side. This place has had chronic issues trying to get tenants in there. I believe the inside is in not so good condition. As a result, the department has had the 25% vacancy on it for a while. That's the same vacancy as the applicant has in their workup. Thus, we are very close net operating income wise. Doesn't seem to be much of a dispute on that point. Page 5 shows the comparables. General downtown area, 979 on the average rents. We're at the lower end. We also have some bachelor units involved. Comparable leases are on page 6, but again, because their NOI is so close, I'm not going to dive into this. 7 and 8 is the capitalization rate evidence on the property. And then page 9 is our municipal act excerpts like you've seen before. Then I'm going to page 10. So this is their income and expense workup. I know between the applicant and myself, a big part of where the difference lies is the expenses on the 2020 income statement. You can see by looking at all the categories, it can be easy to miss something when doing your workup. But there are a few things that appear on sometimes these income statements with huge breakdowns that don't fall into valuation. So I was able to look this over last night when I was getting ready for today, and there are a few items that don't belong. So to try and come up with what the expenses are when removing these items. So at the bottom of page 11, you'll see the total expenses are $784,807.05. That's inclusive of everything. So I'm going to tell you the things I removed, and I'm going to tell you what the actual expenses stabilized were. So going to page 10, there's 4 columns over. It says year-to-date actual. So I didn't exclude anything from cleaning expenses. I didn't exclude anything from repairs and maintenance. Utilities, I didn't exclude anything. Going down to page 11, I didn't exclude anything outside maintenance. Then there's a rehabilitation scheme expenses, $19,803.13. I excluded those. You can see in their budget, they didn't budget anything for rehab. So that renovation expenses I excluded. Then down to administration. This is where the bulk of the expenses The big chunks were taken out. So first thing I removed was a property tax appeal, $556.50. I removed amortization because that's in regards to mortgage payments. That's not something that's included on a yearly net operating income for appraisal. Mortgage payment was also excluded. Mortgage principal reduction was added back in. Tenant deposit interest was removed, and capitalized assets, which is exactly the same as the rehabilitation scheme expenses at 190313, were added back in. So basically they're saying that 19,80313 in their own income statement, they're saying that this is a positive. We spent 19,000, we're taking it out of the income statement. So long story short, when you actually add up what the stabilized expenses are, they're 369, 649, 69. Now that is about 20,863 more than the modeled expenses. So the model expenses are about 20,873 low. However, when you look at the actual income they collected at 727,857, comparing it to the model income is low by about 11,000. So basically the difference is, long story short, the net operating income the city has for the combined expenses for the residential side is $9,777 too high. It's 2.65%. So it's pretty close. We're only looking at one income statement year. So therefore, I didn't make a change in that regard. I'm looking at a Microsoft Excel table, but unfortunately at the time of making these briefs, I didn't have time to do all this work, but I can tell you that's where we differ from the applicant on the expense side of the coin. So I didn't make a change on the property. We're at 2.6% off in the net operating income. The rest of the brief, you can see on page 12, shows the pictures from the inside. They did some renovations. It looks like they have some mechanical on the roof, and the interior looks good, renovated interior. So that's my evidence for 279 Portage. Thank you.
Thank you. And Rocky, any questions?
Yeah, I just picked up something there. I think you might, well, maybe clarify this. You said something about actual income. Did you say that the income was, what that income was? You
The actual
compare
income from the income and expense statement, yeah, 727,856.84.
Right, and that's on your page 10, and that includes the commercial rent and the residential rent, correct?
That's the commercial rent, but that's also commercial 100% vacant. You can see on the
Right, yeah, exactly. And what did you use for your apartment rent?
For apartment rent, okay. The apartment average rent was $979.
No, the total 752,000.
That's gross potential. The effective gross income is 760 and 761.
760. Okay, so that's after your vacancy was 4.7.
Right. Yeah.
And so the difference there isn't the model or anything. This is very close, except for the fact that they're still absorbing, right? That's the difference here, isn't it?
What do you mean by absorbing?
Well, if you look at the statement, you'll notice that they've got a pretty, about an 8% vacancy rate at this point in time, right? And you've got four.
Well, I mean, are you talking after the discounts?
Discounts are permanent. That's just a bookkeeping thing. The vacancy is 74,000 on a potential income of 824.
Yeah, my preceding analysis was just based on the bottom line in terms of effective gross income.
But that's a little over 8%. So really the difference, what you're saying, isn't anything but likely the difference in the vacancy rate, isn't it?
Well, I mean, if they're still absorbing, then it would be presumed that the actual effective gross income would end up being even higher.
No. Now, you were talking about expenses, and do you know what the rehabilitation scheme expense is?
No, there was no detail in regards to what that rehabilitation scheme was, but
You took it out without knowing, right?
No, I took it out. I did leave it in initially, but then I looked at where you at the very last line on page 11, administration capitalized assets, and noticed that 19,803.13 was exactly the same as the rehabilitation scheme. So it seemed to me that they're saying that we spent this money, but we're also taking it off our net operating income because we're seeing it as
Okay.
a bonus.
All right.
Yeah.
I see what you're saying there. Now but you didn't research into it. It's just that I came into this with one of these other the same properties, and that'll be my evidence anyway. And now you feel that property tax appeal is not an allowable expense. You want to explain that?
Well, they didn't budget for it, and it's not something. I mean, it's up to the discretion of the owner. It's not necessarily that something that happens year after year for
Is
every
that
property.
discretion? I mean, he pays more taxes or he appeals it and tries to reduce it. You think that's a discretionary thing?
So he pays more taxes or he appeals it and tries to get it knocked down. Well, yeah, that's what he wants. Sometimes I know I've had
You can't,
discussion.
but you can't take both sides of that argument and say one counts and the other one doesn't. If the taxes, if the appeal fees don't count, then you got to question the taxes.
I don't
They should be higher. They should be higher. But have you not heard about this philosophy that professional fees in revenue producing properties, if they pertain to the operating expense, and the operations are an expense. If they pertain to issues outside the operation, such as marital split, and you're trying to put the fees in there, they don't count. You've never heard that? You don't study that?
No, I'm not married. I don't know anything.
No, it just bothered me. We had a hearing a couple of days ago where we got these people saying, no, property tax fees aren't an expense, and that's ludicrous. If it relates to the operation, then it's an expense.
Does every property?
If you don't incur that expense, then you have higher taxes.
Is that a question or a statement?
No.
Well, we're only talking about $550.
I know. Professionally, it bothered me.
Out of expenses of $780.
It bothered me. So okay.
Not every property appeals their taxes, so it's not something that they budgeted nothing for it.
Well, I'm okay. My question is maybe it's just the property assessment department taking a shot at people who take a shot at them.
Well, I mean,
Okay, let's move on.
Thank you. I had to say it. Okay, sorry. Now, so the cap rate again, so this is the same thing. This is a model generated because your model determined that the effective year was 1921.
That's what the effective age we have on the property. We also have another metric. It's income quality, and sometimes that's where the confusion can be seen. Where you see like the last property had a higher effective age, but a lower income quality. So that's something that we're looking to clean up and make more consistent on a go forward basis. But I can see where you're going with this, and it makes sense.
Yeah, I mean, I'm not trying to nitpick and or cherry pick whatever, but I don't see a consistency there. And
Yeah,
so again, another mythical factor in the model.
Well, it's not mythical; it actually exists, but it doesn't appear on our grave.
Those are my questions. Thanks.
Thank you. Linda, any questions?
No, I have no question.
Gail?
No, I have no questions either. Thank you.
So Matt, the question I have is with all of these calculation changes, did you revise your workup?
No, because we're 2.6% apart, and that falls within, in my opinion, scope of reasonable difference. We're also only looking at 1 year. Perhaps if I looked at, if I had time to look at multiple years, it would be different. But when the percentage difference is so close, I'm not going to make a change.
Okay, thank you. That was all my questions. So that concludes this property.
Or
You didn't make it.
Oh, I was testifying during his part, so maybe you thought I was not.
It's been a long morning. Okay. Rocky, you're up.
The statement on this, just to clarify a couple of things, because we did run into this on another one. Every company makes their own statements, and this rehab scheme expense is not a capital cost. Generally for these properties, what they do is they run accounts to it's like a reserve or a cost that for apartment turnover. And it kind of took me by surprise at one hearing I had with 6 owned by, and I went back and checked it out. So we took it as a real expense because that's the way they treat it. I see that there's a capital adjustment below, and now I'm just wondering about journal entries. They got to match up somehow. So but on that basis, our NOI from the statement was 337,000, and listening to the assessor and treating the tax appeal fees. By the way, that was an appeal fee to Board of Revision. That expense. That's exactly what that number is, their income is arguably 337 or arguably 356, and so the difference between us and the assessor is marginal on, and he's $11,000 higher, and I think I heard him conceding that he was 2.6% off. This is mostly a cap rate issue again. Building built in 1911, and regardless of what the effective age is, it's still suffering from the concept of being a poor investment. I think everybody knows where this is. Got a really good visibility at the corner of Portage and Smith.
Gary, I think.
No,
No, you're right, Smith.
Smith, yeah. And it was, until the conversion, it was a working building as an office. And I don't know what the vacancy was like, but they converted this to multifamily, and they had actually some difficulties and delays for the 2018 appeal, for example. It was assessed at $1 million for land value because of the delays they had. And then when it came on stream, the assessment obviously increased to the potential value. And what we're saying is that we really see no need for an increase here from the 5.5 million to the 5.4 million to 7. That's not right. Anyway, the old assessment was about 5.5 million, and now it's 7 million. Nothing's happened. It's still absorbing into the market. The numbers haven't really changed, and the first floor is still a problem area. And the difference is the cap rate. Now on this building, again, it's the same thing. We have a historical designation, and I'm trying to remember if this one had affordable income units, and I don't recall. It's of course typical of downtown. There's absolutely no parking on site, no access to parking. It is what it is. The other properties we were looking at had at least some on-site parking, which is always a convenience. in what I've been saying all along, but first floor, this entire hearing anyway, but first floor retail office being difficult to fill. Again, this is another indication. I think for 3 or 4 years, they had a Vespa scooter on display in that first floor. That's to try to entice people to come in and rent it. But you know, you're next door to a Dollarama, across the street from a dollar store, down the street is a giant tiger, and that tells you about the attractions in the neighborhood. It's not conducive to that. So that's a negative on it on the income side of it. The other thing which and I'm just bringing this up today because I didn't prepare this, but the floor plate itself, it's a narrow lot, so it's not a very large floor plate, which means a restriction in unit configuration. Not really that desirable, but aside from that, again, it's the same story. Downtown historical destination, not always market-driven transactions. They're guided by what political will and support to change something that the market isn't changing. It's just as crazy, and I don't, hopefully I'm not insulting anyone, but I heard one of our politicians saying we should put an extra tax on parking because that'll entice them to build on downtown parking lots. Wow, why would that work? It just means it's going to cost more to park. If the market's not doing it, to get them to do it is, well, there's inducements like this, and penalties will have the opposite direction. It's the concept of political in the market, and it does not make a good investment, and that's why we're looking at higher cap rates. Thank you.
Thank you. Matt, any questions?
No questions.
Linda?
You're applying a 25% vacancy across the board, but when you talked about the income statement, it sounded like the actual vacancy on the apartment side of it was much lower than that. Correct?
Well, it's the way some people interpret statements. And if you look at the page 3, you got the vacancy and you got the discount. So the discounts are generally semi-permanent, and it'll be like a first year free rent. But next year, when they re-sign, they'll probably have to give that away again in today's market, or they'll have to continue to offer inducements. And also it on this particular property, you have 800 and I'm only trying to figure this out. 824 potential, and there's 65 units. Yeah, that's going to come under RTB when it comes off. So what they're doing is they're registering the rents at RTB as well. And they might not be getting that much for it, but down the road, should things improve,
They can take the discount.
they can take the discount off. Yeah, because it's under the RTB limit right now on the average. So when we look at these statements, you know, you got 109, 110,000 of income vacancy on 824. So 13.3% cash. And what I was saying earlier is the number, the operative number. I mean, the 35,000 is going to probably stay a constant for a long time. The real number then would be on occupancy side would be 74,000. So they've probably got a physical vacancy of about 9% and a cash vacancy of 13%.
Okay, thank you.
And Gail?
No, I have no questions. Thank you.
And I have no questions. Thank you. So that concludes that property. And the last one on the docket is 1830 Portage Avenue. And Matthew, you can make your presentation.
Okay, thank you. One moment. File number 2649, roll number 070213333000, 1830 Portage Avenue. Again, mixed use combined at 1,235,000. 1952, we don't have any effective age on it, 12 suites, sorry. Construction class C masonry bearing walls. Request for income information, I think compliant. Property sold January of 2016 for 975,000. Page 3 shows our modeled workup here, how we get to our total combined property assessment. Page 4 shows our average rent per suite and our net rent per square foot. On the retail component, there was no commercial information returned on their income and expense statement. So I can't actually say what the building at the back, it's a decorating company, the net rent is on the property. Pages 10 to 14 shows the mailer they returned. The page with the commercial information wasn't returned. So just maintain the model on it. The comparables are on page 5. They're all on Portage. The average monthly rent falls within the range, doesn't have any bachelor suites like 3 of the 4 properties do. In that list, comparable leases, just taken from the area, got 2 on Portage, 2 on Ness, the $13 to $16 range. So we're within the lower end of that band there. The ones on Portage, you can see are higher. The decorating company, it's like the building that's behind the apartment. So its exposure is not as good as having a Portage facing unit. So that would be one reason why perhaps the rent is a bit on the lower end compared to the other Portage comps. Nevertheless, it looks like it fits into the range. Page 7 shows, I took a look at the income and expense statement. So this is just looking at their reported net operating income and expenses. So with vacancy debt, bad debt parking not rented, we're looking at about 10.78. So that's an 89,606 reported expenses. Their R&M again is high. Now I don't know if that has anything to do with them renovating units, and whether there's a connection between those two pieces. Why sometimes you see when the R&M is high, they're renovating so they can't get people in there, so that boosts the vacancy up. But I don't have any permits, records, or inspection on that. That's just a potential reason, but I can't confirm or deny that. So like both the applicant and I have done in this hearing, I used $1,500 a unit to revise the expenses and came out to a net operating income that was about $4,350 different between our net operating income and the model net operating income. We don't have the commercial information on this property, and we're pretty close, so I didn't make a change in this regard. So I just went model with everything. That's my evidence. Thank you.
Thank you. Rocky, any questions?
I don't suppose you've ever gone inside the commercial portion?
No.
Okay. And in regard to the statement that they provided on page 11, did you attempt to see if there's an adjustment you could make to the maintenance and repair?
I used 1,500 as a hypothetical on my page 7.
Page. Oh, okay. So that's what I was wondering what that was. So on that basis, you feel that 52,000 would have come out. And was that the only change?
Yeah, that was the only change I made. I know the management was about 5.2, but it's pretty close. If we push the management down to 5%, it would probably bring it up a couple $100, but it wasn't much of a difference. And I didn't make a change, so I didn't include it.
Okay, yeah, no, that's I see that now what you did. And is there an occupancy permit for the commercial operation, do you know what?
Oh, I don't know.
Or is there a business tax?
I don't have that information in front of me.
Okay. These caps were again model generated.
Yes.
Now, did you consider the sale in 2016?
I saw it. I know I've had this property before at the board, but I didn't really put much weight on it. I can't remember if someone told me they were renovating. It was purchased for the point of renovation or not, but I didn't put weight on it, no.
All right, those are my questions.
Thank you. Linda
I have no question.
and Gail.
And I have no questions. Thank you.
And I have no questions. Thank you. Rocky, you're up.
Thank you. The property, much like what was the other one? The comparable we were discussing earlier, 510 Burnell. It's exactly the same situation. This is owned by Zach and Sons was their name, and the part at the back was his workshop, and it wasn't a how do I say it? It wasn't a true commercial endeavor, although he did do some outwork on it, and he owned the apartment block as well. So for years, it had been historically assessed at other and with a nominal rent. And when it sold in 2016, it sold to Smith Agency, and Smith had been managing this building for a long time, for as long as I've known them. And it was just another one of those issues where we have a longtime friend we've done work for, and he wants to get rid of it. And don't offer in the market, we'll buy it from you because it fits in with our portfolio. So not an arm's length transaction. And after the sale, I was talking to Dave, the property manager. He said that place is now empty, that they're not using it for anything, and they're just using it for storage. And so I don't know if we've gone to the trouble of trying to change the classification on it, or look at it treatment for something else. But for now, we're not going to be disputing it, because I think that's something we can do outside of the appeal process. I just wanted to let you know it is empty now. There's nothing happening there. Last I talked to him. The issue on the expense side, and yes, the assessor did pick up something. It's not renovation. This building for the last 10, 12 years, they really haven't spent any money on it. So Smith have a different concept in mind. They keep their properties up. So what it has been is, these are real maintenance repair costs, but these have all for deferred maintenance. This is 10 years of work that they're just catching up on. It is higher than normal. And this reason for stabilizing it is not the category it belongs in, but the time frame it belongs in. So we do agree with that. And we came up with a very, very similar number to the assessor on the income when you're looking at the actual. I believe he thought maybe around 52,000, and then we put 54,000 on it, and the model's at 56. Again, these are very small differences, and probably wouldn't appeal on just that. But the big issue here is, again, is going back to the cap rate. You're putting weight on income that's coming from a shack in the backyard. It doesn't remotely resemble an investment property, and it's not generating money now. You know, if you're going to include it in the income, you got to treat it as a major risk. And that's the way I would look at this. And I did not prepare this cap rate calculation here. I gave some guidance on it, but I would have been much more aggressive on looking at income growth potential and tenant strength and stability, because putting it in the shack, you're not going to get a tenant for it anyway. And not only considering the issues in today about occupancy permits. See, there's a simplified occupancy permit issue right now where if you maintain the same use that was in there prior, you can go to PP&D and get a permit and they'll grant you one. No longer do you have to worry about just because if you change the company, you can now sort of inherit the usage. But if it's been empty for a year, you've got to go out and get a new permit. And when you have to go out and get a new permit, you have to meet code. I don't want to, let's just say that that's an obstacle. And I think that there's no motivation to spend money on it to get a permit for something that won't generate income. And really that's our issue with it. Normally, I think without relying on that, you would probably see a cap in the high fives, and we just went to 6 because it's just it shouldn't even be included in it. So the alternative would be take the income out entirely and treat it in a cap in the 5s, or not 5.5, but maybe 5.6 in that ballpark, or leave the income in and look for an overall in the 6s. I think that's a fair thing. And if I get some time, I'll try and find out and let Matthew know if we're planning on asking for a class change on that.
And that's it. Matthew, any questions?
No questions.
Linda
I have no question.
and Gail.
I have no questions. Thank you.
And I have no questions. And so that concludes this property, and we've heard all the items on the schedule today, and this hearing is now adjourned. Thank you very much, everyone.
Thank you.